Hey guys, Chris from Adapt Solution here, and this is video number 1 in my balance sheet series. If you want to see the other videos on this playlist, I'm going to put a card up there and the link in the description below. So be sure to check those out as well. Okay, so before we go any further, I just want to let you know I approach teaching the balance sheet very differently from most teachers. That's because I don't believe in giving you a format and expect you to memorize that. I like to break things down into fundamental components because I honestly believe that trying to learn off a whole format, that whole long format, is like trying to eat a whole burger or a whole roti or whatever it is. By stuffing the whole thing in your mouth, trying to swallow, you're probably going to choke, you're not going to enjoy it. So what we do is we bite off a piece, you enjoy that piece and you go back for more. So same thing. So just like how I approach teaching the income statement, I broke it down from that whole format into just selling price minus cost price. So I'm going to do the same thing with the balance sheet and build up from there. Okay, so just be mindful of that. And be mindful you're going to see multiple formats that might look different from what you may know from school. But just be mindful that there's no one right format for a balance sheet. Okay, so I have a question for you. Why do people start a business? To make a profit. Good. Now, yes, there are other reasons why people start business, but we're just going to assume for now that's the reason. So quick question. How do we calculate profit? So we could go back to consumer arithmetic from math and say, well, that's simply selling price minus cost price. You'd be correct. But if you want to scale it up to be a bit more technical with it, we say revenue earned minus expenses incurred. Now what's revenue? Well, that's the money you make by doing business. So how do you earn revenue? What can you do? What is the business you do? Well, it's one of two things that people do. They either sell goods or they provide services. Right? So we know what goods are. Those are things you buy and resell, or you can make them and sell them to people. And services, well, that's when you're not selling an item or a good. You are doing stuff, for example, like how I provide tuition. Lawyers and financial advisors provide advice based on their knowledge and experience. But regardless of whether you are selling goods or providing services, you need resources to do that. For the goods, you need the goods. The goods themselves are resources, right? And even if you're making it, the materials you use to make those goods, those are resources as well. For me, my resources are my laptop, my recording equipment, textbooks, desks, that kind of stuff. So we need resources in order to provide goods or services. So there's the next question now. Where do these resources come from? Or let's say slightly differently, where does the money to purchase the resources come from? That's a good question. Well, the first place it should come from is the owner of the business. Whatever money the owner puts in from his or her personal savings, that's known as capital. Now, that's sufficient for CSEC POA. For other accounting courses, you can call it equity or equity capital, right? But for CSEC POA, capital should be sufficient, okay? Now, whatever the owner puts in is capital, and the capital is used to purchase those resources. And those resources are collectively known as assets, right? Now, some of you all might have met a definition of assets, and there are many, right? But at the heart of it, an asset is anything that the business owns and controls and uses to generate revenue. Now, the truth is, the definition gets more technical than that, but for a CSEC Form 4, Form 5 level, I believe that definition is sufficient. If you want to do some more research, you can Google IAS 1 and you should find a slightly more technical definition of assets there, because there are several things that apply to assets. But anyhow, that's what we're going to go with for now. So what we want to be able to do is we want to be able to communicate at any point in time what are the resources of the business and how were they financed. Where did the money to buy these resources come from, right? So we're going to start with just assets and capital. Now I know some of you always say, but Chris, there's something else. What about the L word? We're going to come to that. Again, I want to build up piece by piece. So the first thing to me that makes sense, that's intuitive, is that when someone starts a business, they put in their money and they use their money to buy these assets, right? So we're going to take a look at a balance sheet now, right, that just has assets and capital. Okay, so we're looking at Luca Y, who started a business by contributing $50,000 in cash from personal savings on 1 Jan 2020. So prepare the balance sheet, well, statement of financial position as at that date to show the above information. Okay, so when you're preparing a statement of financial position, a balance sheet, any financial statement, you need the name of the entity, the name of the statement, and the period to which it applies. So we're going to start with Luca Y, that's the name of the entity, then statement of financial position or balance sheet, and as at 1 Jan 2020. Now it's as at and not for the year ended, right? Because a balance sheet is giving information at a point in time, not for a period of time. Think of a balance sheet as a selfie and think of an income statement like a video, right? So what we're going to do now, so again, like I said, this format is just a very simple format. You may have seen a different one, that's great. But what we are presenting in this statement is information about the assets of the business and how they were financed. And there is flexibility in how you present the statement. So you can head up assets, you can put cash, and you can even have a subtotal for cash, for assets, sorry, right? Then we say financed by, and we put capital or equity capital if you prefer, and we put the subtotal there as well. As you can see, the value of the assets is equal to the value of the capital invested by the owner, because, and in this case, all that happened was the owner put in money to the business. So the money in the business is the asset. Where did it come from? It came from the owner, right? And as they say, our balance sheet balances because it's the total here is equal to the total there. Cool. So that's your first balance sheet. Okay, so that was your first balance sheet. As you can see, it was relatively easy. And yes, I know some of you are saying, but I didn't get that format. Again, we're going to build up the more complicated formats, but we're starting simple. Now, again, I heard some of you all saying, but Chris, what about the L word? Liabilities. What about that? That's the accounting equation. Yes, it comes into play, and I'm going to bring it in now. But again, I was starting simple because to me, it makes more sense. It was more intuitive just to talk about assets and capital. The resources the business has, and where did it come from? Usually the owner is the first place it comes from. But let's talk about liabilities now. So what's a liability? So let's backtrack a bit. So when the owner starts business, sometimes they have enough money to buy all of the possible assets that they need in order to do business. Sometimes, however, they don't have enough money to buy all the assets they require. Because remember, you're supposed to have a business plan. You're supposed to plan ahead about what you want to buy, where you're going to buy it from, etc., etc. So if the owner finds themselves in a position where they don't have sufficient capital of their own, what do? Do they just buy some assets and hope that they make enough money to buy more? Maybe you could do that, but that mightn't be the best plan. So what some people do is that they borrow money. They go to friends, family, or financial institutions, and they borrow money from them and use the money borrowed to buy assets. Now, any money that is borrowed, you have to pay back. So you owe your friends, your family, or the financial institution, you owe them the money, right? And we classify any money owed to any entity other than the owner as a liability. So any money coming into the business, any resource coming into the business from any entity other than the owner is a liability. And the business now has an obligation to repay that liability at some predetermined time, over some period of time, whatever the case is. Now, some people think that liabilities are the opposite of assets because you owe liabilities and you own assets. So that's a nice way to think of it, but they aren't actually opposites. We use the money from liabilities to buy assets, all right? Anyhow, so that's an interesting implication. So the money the owner puts in and the money coming from the liabilities are both sets of those things are used to buy assets. So that actually modifies the equation we saw just now. So it's no longer just assets equal to capital. It's assets equal to capital plus liabilities, because the value coming in from the owner and entities other than the owner, that value is used to buy assets. So it has to match. The asset value must match with the capital plus liability value. Let's take a look at an example and see how it goes. Okay, so we have example 2 here. So it says Go or Y. So Go is clearly Luke's cousin. Started business on 1 Jan 2019 with 60,000 in cash from personal savings and also borrowed 40,000 from a bank which was deposited to the business's bank account. So prepare the balance sheet to reflect the above information. Okay, so let's head it up properly. So we know what we need to put. The name of the entity, the name of the statement, and the period to which it applies. So we'll start with our assets, and we're going to put the bank and the cash, right? So the amount in the bank was 40, the amount in cash was 60, and the total for assets would be 100,000. Now, that shows the resources of the business, the assets. What does the balance sheet show? The assets and how they were financed. Where did the money come from to purchase those assets? Now, of course, we're not buying a bank account, we're not buying cash, but that's how we are going to buy resources. So where did the cash come from? Where did the money come from to buy the assets? So where did it come from? All right, so this was financed by capital, the 60,000 from the owner, which we saw up above there. And we also have some liabilities now. Well, a liability, sorry, 40,000, which is the bank loan. And when you add the 60 and 40, we get 100,000, which matches with the total asset value. So again, the total value of assets must match the total value of capital and liabilities, because this is what came into the business, and this is where either what was done with it or it matches exactly what was put in before we do anything with it. Now, let's complicate things a little bit. Okay, so what we just saw was a very simple balance sheet with the three elements: assets, capital, and liabilities. And it showed the relationship, the assets and how they were financed. The total value of assets is equal to the total value of capital and liabilities in the entity. Now, there is an alternative presentation called the net asset presentation, where we show, instead of assets equal to capital plus liabilities, we show assets minus liabilities equal to capital. Now, the reason for that is it's just a preference, right? It's an alternative that we can use simply for the sake of showing things slightly differently. It doesn't change the fundamental or underlying concepts, it just presents it differently. Let's take a look at that same balance sheet, but now with the net asset presentation. So we have the same information: Go Y starting business 1 Jan 2019, 60,000 from personal savings, borrowed 40,000. So we want the statement of financial position, right? So we already headed it up. So we're going to put the assets, right? Bank and cash, 40 and 60, giving us a total of 100,000. Now we are going to put the liability here. We're going to put the loan here, and notice it's in brackets. It doesn't have to be in brackets. You don't have to have a negative sign, but I need that as a visual cue, at least when I'm teaching, right? So what we do is we take the total assets and minus the total liabilities, and this gives us net assets, right? Now, net is a prefix, meaning after deductions have been made. So net assets means after having deducted liabilities. So you have what you own and what you owe, and you could use what you own to pay back what you owe, and what you're left with is the net assets, what you have left after you have paid back your liabilities. And of course, this has to match your capital, right? Because it's simple arithmetic, right? If assets was equal to capital plus liabilities, and you minus liabilities from both sides, you must get capital back down on this side, right? And you could see it here, right? 40 and 6 is 100, minus the loan of 40 gives us 60. So net assets is equal to your capital, right? Sometimes capital is also defined as the value of the residual interest after covering liabilities. Again, if you get a bit more technical on that, please feel free to Google it. Okay, let's take a look at the next item. Right, so as most of you watching this video may know, businesses tend to have more assets than just money in the bank and physical cash in hand. They have things like vehicles, machinery, equipment. Earlier in the video I mentioned stock, right? And we know about maybe selling things on credit and having debtors or account receivable. So we have a lot more detail that can go into a balance sheet, a lot more assets. And part of accounting is classifications, putting things in particular categories according to a particular logic. So we don't want a balance sheet or a statement of financial position with a random order of assets. We need things to be presented in a way that is logical and allows people to look at the balance sheet and be able to understand what is there relatively easily. So the same thing applies to liabilities. We don't just want a random list of liabilities. We want some sort of logic and order to it in order for it to be easy to understand. So to that end, there are two classifications of assets and liabilities: current and non-current. Now, current assets are assets that are used up or converted into cash within, well, people say less than 1 year or the accounting cycle. Let's just go with less than 1 year. So within 1 year, if the asset is used up or converted to cash, it is classified as a current asset. Now, usually we have 4 basic current assets, and the list will increase in the coming videos. The first one we talk about is stock or goods or inventory or merchandise, whatever you want to call it. Now, why is that a current asset? Because when you buy stock, you intend to resell it within a year, right? You don't buy stock and hold it for 2 or 3 years. What's the point of that? You want to make your money as quickly as possible. So it is assumed that when you buy your stock, you are going to resell it within a year, okay? Next is the debtors or account receivable. So when you sell on credit, you expect to be repaid within less than a year. You're not going to allow people to take longer than a year to pay it back. I mean, in these COVID times, maybe you might make an exception, but generally, you want people to pay it back within a month or 2, maybe 3 months at a stretch. 6 months if you have a good relationship with them and you know they're kind of in trouble. But let's not get too technical, right? All right. Then you have cash in the bank, which is already cash, technically speaking. Not technically, it is cash. And then physical cash, which of course is cash, right? So those are your current assets. Now, current liabilities are liabilities that we expect to repay within a year or within a year from the balance sheet date, right? So in other words, if you have something, a loan or whatever, and you have to pay it back within a year, that's a current liability. If they tell you, okay, well, you know, you borrowed $1 million, we're going to give you 10 years to pay it back, then it's not a current liability, all right? Now, in terms of current liabilities, again, I'm going to give you a very basic list now, and we're going to increase that list as we go along. So your creditors or your accounts payable, those are people who you intend to pay back within a year. Like when you, just like how when you want your debtors to pay you back within a year or less than a year, you need to kind of reciprocate. Right? People are not going to give you a year to, more than a year to pay back. When you buy goods on credit, you're going to pay back for those within a month or 2, right? Now, we also have a couple others that I will actually hold off on for now, but when we get to it, I'll explain it, all right? Now, that's current assets and current liabilities. Current assets used up or converted to cash within 1 year. Current liabilities repaid within 1 year. The opposite of current is non-current. Now, I know it sounds relatively simplistic, but we used to call them other things. Non-current assets used to be called fixed assets. Non-current liabilities used to be called long-term liabilities. But they decided they wanted a slightly more uniform look at it, and I think there were some subtle differences in the definitions of certain things, and they wanted to kind of harmonize those definitions. So current is either current or non-current. So non-current assets are assets you expect to last for longer than 1 year. Again, these definitions can get more technical the higher up you go in accounting, but for now, we'll just go with that definition. So for example, vehicles might last 2 to 5 years, maybe sometimes longer if you take care of them and you don't drive on Trinidad roads and then potholes. Anyhow, equipment, furniture, fixtures and fittings, property, plant and equipment, land and buildings, right? Now, we'll talk about order a little later in the video. Now, non-current liabilities, those are loans you pay back over periods longer than a year, right? So the popular ones are mortgages and simple long-term loans, right? Now, let's take a look at a balance sheet that has these elements in it and how we structure it. Okay, so we're going to take a look here at the balance sheet for Luca Y, and we have a trial balance here, right? Now we have our assets listed first, and then we have our liabilities and capital here, okay? So the order in which I'm going to list these things is called the order of permanence, and it's one of the 2 orders that you're required to know for CSEC POA. Permanent means long-lasting. So when we present assets in order of permanence, we start with the most permanent assets first and then go down to the least permanent. So we start with non-current assets and then we go to current assets. And the last one will always be cash, once you have cash, all right? In terms of capital and liabilities, capital is presented first because capital is more permanent, or is usually thought of as more permanent than liabilities, because you will repay your liabilities eventually. The owner's investment in the business is usually permanent. It stays. Now, the owner does get rewards, but usually doesn't take out his or her initial investment. Again, opinions could differ on that. That's fine. Leave it in the comment section below, sorry, and we'll talk about it there. So let's take a look and see how we would construct or prepare the balance sheet for this information using the classifications of non-current and current and the order of permanence. Okay, so the statement is going to be a bit long vertically, so I'm going to do it in kind of pieces and show you pieces as I go along. So the first and most important, well, not most important, so the first thing you need to do is head up your statement, right? Luca Y, statement of financial position. Now, you don't have to put this financing presentation, that was just my little note there. So the financing presentation shows assets equal to capital plus liabilities, right? And it's as at the 1st of Jan 2020. Okay, so let's scroll down so we could see things a bit more clearly, right? So, okay, so we're going to start with the non-current assets first, right? So let's put those in, and if we look across here, we have land and buildings, equipment, fixtures and fittings. The rest of these assets are all current assets, like I said, stock, debtors, cash at bank, cash in hand. So these three will go inside here, and they'll go in that order. Now, I like to put my stuff in the trial balance in order that it will appear. That's not how you're going to get in your CSEC paper. They're going to mix it up all how, just to make life frustrating. Okay? But just for the sake of simplicity and to kind of have things flow a bit more easily, I kind of put it so it's easily transferable. Okay? So land and buildings, so those three assets are going to go here, right, in that order, and we're going to put a subtotal, right? Now, I can hear some of you all saying, but sir, why are these figures in this column and this figure in that column? All right, so once again, the use of columns tends to be a bit of a sore point for a lot of people. My philosophy is this. I want my rightmost column to have the most important totals and least level of detail. So when I look here, I'm just going to see my totals for my different sections, and then ultimately, or different subsections, sorry, and then I'm going to have a grand total for that whole section. If I want to know what made up this subtotal, I'm going to go to the left. Right? So every time you want to add details, you go one column to the left. Again, it takes some getting used to. Maybe you guys learned a single column presentation, which is also fine. We might see that a bit later on, but for now, we're just going with this, right? So the left column will be used for the details, the right column for the subtotals and grand totals. Okay, next, we're going to talk about current assets. So like I said, that'll be these items here, stock, debtors, bank, and cash. So we're just going to plug them in, and we're going to put a subtotal. And now we're going to add these two to get total assets. Right? Now some people like to put a line item, well, a label that says total non-current assets and total current assets. If you want to do that, that's perfectly fine. It's not mandatory. And if you don't have those labels, you're not wrong. Okay? Now, from here, let's take a look at the capital and liability section. But I'm going to scroll up a little bit. Okay, so we're going to head up financed by capital and liabilities. All right? So the capital is given to us across here, 1 million. So we're going to put that first, capital 1. Right, now we're going to put in, so we have some liabilities here. So let's take a look. Accounts payable is 90, loan payable in 6 months is 60. These two are current liabilities because they're payable or repayable rather within less than a year. The loan payable in 10 years, that's 150. That is a non-current liability. So we're going to put that for sure, right? So non-current liabilities payable in 10 years, 150, right? So now we have our current liabilities. We have two items, the accounts payable and loan payable. So let's put those items, shall we? Yeah, sorry, I forgot to put my total, my subtotal here, right? And now we have the subtotal for this item, 150. So when we add these three subtotals, we're going to get our grand total of 1.3 million, which as you can see, matches with the total asset figure. Okay, right, so again, I know some of you will probably have questions as to why we use the columns for certain things, but again, as you can see here, the trend kind of continues. This section, this column, has the least level of detail, as in it just has the subtotals and the grand total, and then you have your details for each of those subsections, one column to the left. Again, this is not the only way you can do it. If you've learned another way and you're more comfortable with that, that's fine. But remember, there's no one right format. What's more important to pay attention to is what you are reporting on. And yes, how it looks, because we don't want a cluttered or a statement that looks very confusing. Okay, so with this now, what we're going to do is I'm going to show you different ways that this one balance sheet can be presented. So let's take a look at those. Okay, so remember earlier in this video I showed the first small balance sheet was assets equal to capital. Then we had assets equal to capital plus liabilities. And then I rearranged that to assets minus liabilities equal to capital. That's what I'm going to do now. So the same information I used in the previous question for Luca Y with the different sections, non-current and current. I'm going to use that now when I'm going to show you the net asset presentation. And again, it's still in order of permanence. So I've already headed this up, and you don't need to put this net assets presentation. That was for me for the video and for, well, the students who use the handouts, right? Just to know what it is. So we're going to start with the non-current assets, right? So we have those three things already. So we're going to put them and the subtotal one time. Then we're going to go to current assets. We have 4 of those, so we're going to put that and the subtotal one time. So now we have to put the subtotal for total assets, 1.3 million, right? So again, as you can see, nothing so far is different except that I have 3 columns. And I'm going to show you why. Remember I talked about the different levels of detail, right? So we're going to come back. So let me finish my balance sheet first. I'm going to come back and explain that 3-column presentation. I'm going to scroll down a little bit so you can see the liabilities a little better. So remember, we're dealing in order of permanence. So the non-current liabilities will have to come first. So I'm going to put the non-current liabilities first. Again, I only have 1, but I'm choosing to show the details of it in this column in case we encounter any other balance sheets where we have multiple non-current liabilities. You would list them in this column and then put the subtotal here. Right? Next, we have the 2 current liabilities. So let's put those in and put the subtotal there as well. Right? So 60 and 90 is 150. 150 and 150 will give us a total for liabilities of 300,000, which is then subtracted from our total assets to give net assets of 1 million. And how were these assets financed? How was this net asset figure financed? Well, remember, the only other source of financing apart from liabilities is capital. So we're going to put that section down here, financed by capital, right? So the capital figure was 1 million, so it was just a plug-in figure, right? Now you're seeing my label, they're saying balance of capital at end. You don't actually need that label, at least not right now. When we come to later videos, that label will be a bit more important. Now, this particular format is actually of good use because I have seen multiple CSEC past paper questions that give you just the assets and liabilities and ask you to prepare a balance sheet. And obviously you would have to know, you'd be expected to know at that stage that you need to find capital, right? Now, if they don't tell you what format to use, you are free to use any format you so desire because again, there's no one right format for a balance sheet. This is the net asset presentation, and as you can see, capital invested matches net assets, which is assets minus liabilities. Okay, let's take a look at another restructuring of the balance sheet. Okay, so this particular format will show something called working capital. Now, working capital or net working capital is current assets minus current liabilities. Now, it is an acceptable format, and there have been multiple CSEC questions that require you to show the working capital of the entity. So you have to know how to prepare a balance sheet showing that. So I'm going to scroll down a little bit here now. So again, we're still in order of permanence, right? So I'm going to put in my non-current assets first. Sorry, wait, right. So non-current assets first. Now notice I'm in my middle column here. I'll tell you why just now, right? And then we have here the current assets, right? 800, 120, blah, 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 blah. Let's put in the subtotal for that. And now I'm going to put my current liabilities here, right? And I'm going to take my total current assets and subtract my total current liabilities to get my net working capital. So this figure of 150 of net working capital was current assets minus current liabilities. And now I'm going to add that to the total of non-current assets to get 1.15 million. Now I'm going to scroll down a little bit so you can see the rest of the balance a bit more clearly. Okay, so what do we have left? We have capital and the non-current liabilities. So we're going to let's put everything in one time, shall we? Right, so financed by capital, 1 million, which matches with the item across here. And then the non-current liability, that goes here as well. 1 million plus 150,000, 1.15 million, which matches with the figure on top here, right? So yes, this is a format you are required to know. So that's why I'm showing it to you here. And again, as you can see, the information has not changed. We've used the same trial balance on the left there to create a balance sheet which shows the assets, liabilities, and capital of an entity at a point in time. All we've changed is the sequencing. It's still in order of permanence, but we are simply moving about different subsections. And the balance sheet is still balancing, right? These grand totals for each, the top half and the bottom half, are always balancing. All right, let's take a look at another format. Okay, so now we are changing from the order of permanence to the opposite order, which is called the order of liquidity. Liquidity refers to how easy it is to convert an asset to cash. Cash, therefore, is the most liquid asset. Basically, liquidity is the exact opposite of permanence. So when you prepare a balance sheet using the order of liquidity, you start the assets with current assets, and then you work your way down, right, to your most permanent assets. Let's take a look. So we have information, it's the same information, but I've restructured it to actually put it in order of liquidity to make it easy to transfer to the balance sheet. Okay, so again, we're going to start with the current assets, which we have cash in hand, cash at bank, accounts receivable, inventory. And again, notice it's the exact reverse order of the order of permanence. All right, so let's put in those things one time and get a subtotal. Right, so current assets, cash in hand first, most liquid asset, then cash at bank, then receivables and inventory. Now, inventory is the least liquid because you're never bound to sell inventory. If you have some inventory and let's say they spoiled or they were broken, you might be able to sell them, so you might have to throw them away, so you might never be able to convert it to cash. That's why it's the least liquid. Current assets, sorry. Right, so next we have the non-current assets. So again, you're seeing a reversal of the order of permanence from above in the previous questions. So let's put that there, and we put a subtotal one time, right? So non-current assets, start with fixtures and end with land and buildings. So land and buildings or property, plant and equipment tends to be the most permanent, hence least liquid current asset. We're going to add those two figures to get a grand total for total assets there, and I'm going to scroll down. Now, let's put in the liabilities. So in order of liquidity, we're going to start with the current liabilities first. I forgot my subtotal, 1 second. Right, now we're going to put in our non-current liabilities. Let's put the subtotal one time again. And we can get a subtotal for total liabilities. The last thing to put in is your capital. Right, so that goes here. Right, and as we could see, sorry, let me scroll up a little bit. Right, the total assets matches the total of liabilities plus capital. Right, and again, as we could see, it's the same information that we've been using for the past few questions. We are just rearranging the order in which it's presented, but we are also still preserving the classifications of current and non-current. We are just kind of reversing how we present it. Okay, all right, let's take a look at a rearrangement of this format as well. Okay, so we're still looking at order of liquidity. What you're going to notice now is that I have a single column here. And we're also going to do away with the sectioning or classification of current or non-current. Now, it's still going to be in order of liquidity, but we're just not going to have those section headers. We're going to have just a long list of assets, starting with our current assets, right? As you can see, cash in hand, cash at bank, receivables, inventory. So same order of liquidity. And this here, you could even check, rewind or whatever, track back and check to make sure it's the same order as any previous balance sheet, right? So it just gives you like a single column presentation, so you don't have to worry about different columns and what goes where into the columns. Now, what goes on with the liabilities? So again, we're going to put the current liabilities first, and then we're going to put the non-current liability after and total up everything. And of course, the last item to go is the capital. So we're going to put that here. Boom. Right, so the advantage with this particular method is that everything looks a lot neater, to be honest. Things are not kind of left and right and center aligned and these things, right? It just gives us a list, right? The disadvantage is you lose a bit of detail with respect to what items are current assets specifically, what are non-current assets. At least you lose the sectioning. Some people prefer the sectioning, some people don't. And again, there's no one right way to do a balance sheet. There are many different ways. Please be aware of that. Okay, let's take a look at the next one. All right, so this is the last version I'm going to give you in this video because I feel it's kind of gone on too long already and you're probably a little tired. So this is the same order of liquidity, but we're putting any working capital in it. All right, so we know what working capital is. It's current assets minus current liabilities. As you can see, we have the same information presented across here. That has not changed. So we're going to put in the current assets first, right? As you can see, cash, then bank, accounts receivable, then inventory. Now we're going to put in the current liabilities, right? So current liabilities, loan payable in 6 months, accounts payable, right? So 300 minus 150, that's going to give us 150 net working capital. Now we're going to put our non-current assets, right? So again, those items come from here. They're put in the same order as in before, and we're going to add those two figures there. Boom. So that's going to give us that figure of 11,150, which we saw in the previous balance sheet in order of permanence where we had working capital. Let me scroll down a little bit so we can take a look at the other liabilities and capital. Okay, so we are going to put our non-current liabilities first and then our capital because it's an order of liquidity. right? And we expect to pay back the liabilities before the owner takes out money, right? And as you can see, 150 plus a million is 1.15 million, which is the same as here. And again, our balance sheet balances are in a completely different style of presentation than we saw above as well. Okay guys, so there you have it. Those are some of the formats that you can use to present balance sheets. Again, there's no one right format. Now you might be asking, so Chris, why did my teacher give us this format and give us a specific order? That's because when you're now learning something, you need structure. It's important to have structure and an order to things, otherwise it's just kind of haphazard. But again, like I said, my philosophy is I like to build things from the ground up, adding pieces as I go along. So I know even after you watch this video, you may still have some questions, and I would encourage you to put any questions you have in the comment section below, right? I will try my best to get back to all of you as well. Now, apart from that, again, the best thing to do in terms of mastering the balance sheet is to practice many questions. It took me quite a long time to be able to balance a balance sheet. And even now, sometimes when people send questions or I have questions I'm doing, sometimes my balance sheet still does not balance. Now, I want you to understand not to panic if that happens. It doesn't mean your whole balance sheet is wrong. That's not how it goes at the CSEC level. You get marks for everything you have correct, and chances are you have quite a bit correct. So stop telling yourself negative things. Very important, right? Anyhow, guys, I don't want to rant on too much longer here. Just know I believe in you guys. You have to have your growth mindset. You have to believe you can learn. Even if you don't know how to do it now, tell yourself that I don't yet know how to do it. I don't know how to do it yet. You see that word yet? That's a very important word because you can learn how to do it. If somebody else knows how to do it, bet your bottom dollar you could learn how to do it too. Right? So don't tell yourself you can't do something. Because if you do, guess what? You'll be right. And as Jim Quick says, if you fight for your limitations, you get to keep them. So even if you might not like accounts, decide that you want to do well at it and keep putting one foot in front of the other. Right? Proverbially, sorry. Anyhow, guys, if you want to check out some more videos, I'm going to put some cards up here. Don't forget to subscribe and check out my website for some free POA handles. I think I might put up this particular one as well. If you don't see it, message me in the comments. Say, sir, put up the balance sheet handout, please. Anyhow, guys, thank you so much for watching. I'll see you next time. Bye.